In this week's update, US markets continue its rotation towards defensives. The outcome when hordes of new, inexperienced traders meet the reality of markets. And Bitcoin, well, it's now in free fall. My name's Garry Davis, and as always, this is general advice in this video. And please remember to like and subscribe to the video. Okay, let's start with some market perspective after another very interesting week. Lots of volatility. Market's not really going anywhere across the week. It's just lots of ups and downs in the middle. So the environment for stocks at the moment really couldn't be a whole lot better than it is. The economic data in America remains really highly positive. There's a few little black spots, but on balance, the economic data really is pretty good. Earnings season, as I've talked about, was really just amazing. So, you know, that is a really good sign for the future for the businesses. What prices do around that is another matter. But I can't recall a period when there's been such a high percentage of companies prepared to raise their forward guidance. So companies are now taking a very positive outlook. And they're only going to do that if they think that, you know, it's well justified. And of course, the outlook for disruptive technologies that we've seen emerge very, very quickly in the last 12 months still remains as powerful as ever. Just because share prices of some of these more speculative stocks have gone down 50-60% doesn't mean that the technology is not progressing and the businesses are not progressing, because they are. So that remains unchanged. But we've got this pervasive fear about inflation and what will the Fed do? Will they have to raise interest rates? Will they start tapering bonds, bond purchases? And that's really what the market is sort of fixated on at the moment. And you know, who knows the answer to that? No one knows the answer to that. But certainly the Fed is softening the market up for the start of bond tapering, and that, you know, that may not be received all that well in some parts of the market. But because we've now got part of the market doing quite well and part of it struggling, the net is that the S&P is really just going sideways. So we may not see that much of an impact at the index level. The big divergences are happening at the individual stock level. Now, the other thing that also gives me encouragement is that sentiment is not at an extreme. It's neither extremely positive or negative. It's just sort of in the middle. And the level of bullishness in the last couple of weeks has dropped away significantly. And you do not get market tops when sentiment is sitting in the middle of the range. You just don't. So that's why I think any corrective phase that we're going to get is probably, if it happens, is going to be short and sharp, because there just isn't that frothiness and that excess to wash out of the market. So are we going to get a breakout in the S&P, or are we going to get a correction? And again, no one knows the answer to that. What we do know is that the high flyers from 2019 and 2020, the tech stocks, the concept stocks, are experiencing very significant multiple contractions. Sentiment is shifting towards reopening stocks. It's centering towards more defensive stocks as people worry about inflation. And so the stocks that were trading on 30, 40 times sales are now coming down and are now trading on, you know, maybe 15 or 20 times sales. And within that, there are some stocks that their growth is so large that the multiple contraction is coming down anyway, just on its own. Forget about the price coming down. And so there are certainly some stocks, not necessarily right now, but there are some tremendous growth stocks that are building up to be really outrageous buys when you look at the multiples of sales and future earnings. They're moving very quickly from being, in 2019, expensive to now being downright cheap when you look forward to 2022. So with all things, we get rotations. They fluctuate from one extreme to the other. And I think there's certainly some high growth technology stocks that are now rapidly becoming quite cheap and will therefore present great buying opportunities. But for now, the reopening stocks are the ones that are benefiting. But just be careful, because a lot of reopening stocks are actually stocks that are facing long-term headwinds. And so they're only going to go so far. And, inevitably on the upside, they'll overshoot a bit. And then the market will realise that they're not doing as well as some other sections, and you'll get a rotation back again. Now, in secular bull markets, money doesn't leave the market. It does in a secular bear market. Money goes to the sidelines and goes into bonds and goes into other things, or just sits there as cash. But in a secular bull market, which we've been in for nearly 8 years now, and we've possibly got another 10 or more to go, money doesn't leave the market. It just rotates around from sector to sector, and that's what we're seeing. So I think if we do see a correction in the market, that's why it's possibly not going to affect the S&P 500 that much, because it's just going to rotate into another area. So obviously the technology stocks and the high growth, aggressive stocks are the ones that are most at risk in a correction. So that's really where the risk is. It's parts of the market rather than the whole market itself. But if we do get a correction, perhaps coming around the announcement of bond tapering, then it's likely to be fairly short and sharp. The way forward from here, I think with this uncertainty about do the indices break out or do they correct from this consolidation, means that more diversification is advantageous. So I've been saying for many, many weeks now that you really want to own most of the things, or most of what you own, you really should be trending higher. And yes, you can hang on to some great long-term stories, but that should be, at this point in time, more the minority of your portfolio. So have that diversity, and there's many areas that are trending up. I mean, the main areas are in America, energy, materials, financials, some parts of industrials, and obviously Dow transports are going brilliantly. So there's many areas that are actually moving along quite well. Doesn't necessarily translate perfectly into Australia, because as I'll show you, particularly with energy, there is a huge divergence between how energy is performing in America and how it's performing in Australia. So own most of what's trending now, but don't lose sight of the high growth businesses. The businesses are still going along beautifully. The prices aren't going up, but that's because it's just the multiples are contracting. But at some point that runs its course, and we'll have some amazing opportunities in technology. Now let me just show you what I mean with respect to the rotation that's happening. So this is the US technology ETF, XLK, against the S&P ETF. And you can see that over here on the left-hand side, which is going back into the middle of 2019, technology, that ratio was rising very steeply. So that means that not only is technology going up, but it's also outperforming the S&P. That sort of reached a bit of a plateau in September, October of 2020, and then it just went sideways for a while, and really started to fall probably about March of this year. So we had a long period where technology outperformed the S&P. The ratio goes sideways, means that the technology sector is doing about the same as the S&P, but then since March you can see it's all started to head south, and we've got lower highs and lower lows. So at the moment we have a downtrend. And if you look at some of the other sectors like financials, you'll see the mirror image, perhaps offset a little bit in terms of time, but it's quite clear that technology is underperforming. Now, why is that important? It's important because in America, even more so than in Australia, fund managers are obliged to try and outperform the S&P in all time frames. So So it's not enough for them to outperform over a 1 or 2 year period. They've got to try and do it every quarter because there's so much competition for funds. And so it's vital that fund managers are in sectors that are outperforming the S&P because that's the benchmark, and they're very light in sectors that are underperforming. And so that rotation, that's what's driving the rotation at the moment. And that'll continue for a period of time until it reaches a new level where it's perceived that it's gone far enough and it turns back the other way. Now, no one knows where that point is because it's partly driven by market dynamics and it's partly driven by sentiment. And they're, somewhat unpredictable measures. So the only way that you can really get a handle on this is just to follow the charts and have an open mind as to what's unfolding. But at the moment, technology is underperforming. That's quite clear. Is this the base? Is it about to turn up? I don't know. But, if I watch the charts every day, I'll be right on top of it. And the same with the other sectors. So that's what's going on in the market at the moment. It's a rotation. It's normal. It just happens constantly. And it just sets up a new set of opportunities. It's no more difficult than that. Sorry, wrong slide. Okay. So turning to American stocks, the S&P pretty flat for the week. It gave up a handful of points, but didn't really move very much. And it's really just in a bit of a sideways consolidation. But underneath that, there is a lot of divergence in the market. I've explained why the concept of relative strength is just so important. It is a driver in the market, and whether you agree with it or not, and it'll run its course until it reaches a level where it starts to flip back the other way. The US dollar slipped a little bit more, still holding just barely above 90. The 10-year yield seems to be now pretty steady between about 1.57 and about 1.66. So it's right in the middle of that range. And the VIX is holding pretty neutral around about 20. We're getting the odd little spike here and there, but the traders aren't overly concerned in terms of hedging at the moment. All right, let's look at the S&P. So there's the big picture trend. So there's a monthly chart going all the way back to 1966, and the red sections are secular bear markets, and the green sections are secular bull markets. And you can see they're quite different in character, and we're in the green zone at the moment, and almost certainly will continue in that mode for quite some time. This is the S&P. You can see we've been getting a series of stair steps higher, corrections to around about the 50-day moving average, and then it's off again. This time it seems a little bit more of a consolidation between the 20 and the 50, and really the question is, will it break out to the upside, or will it break down and we'll get a bit of a deeper correction that happens every now and again? We'll find out in due course. So let's look at some of the other key indicators for the market. This is, just get back to, okay, so this is growth versus value. So again, this is the ratio between the two. We're getting lower highs and lower lows. So value stocks are doing better than growth stocks. But we are in a zone now between 1.55 and 1.67 on the ratio. And at this point in time, we haven't broken down. So the medium-term trend is down. The short-term trend is in a range. So is this it, or is it going to break this low? And that really is, that really is an important aspect about how much further this rotation has got to go. The other one that I found interesting, this is consumer discretionary versus consumer staples. So this is the degree to which the market is turning defensive. And you can see it's only terribly minor, but we're just starting to break down in terms of consumer discretionary versus consumer staples. So that's one to be watched closely, because that very much paints the picture about the sentiment of the market. You know, to what degree does the market want to buy stocks like Kellogg's and, you know, Colgate and stocks like that, rather than consumer discretionary stocks? I must admit, I find this surprising, given the mountain of cash and the pent-up demand to spend cash that there is, not only in America but in Australia. So I would have thought this is an environment that was very, very good for consumer discretionary. And I think that is the case. This is really just about the shift in market sentiment, which doesn't need to make sense. It is what it is. And, you know, it's just the market turning defensive. You know, who knows? Maybe it's the sell in May, go away theme. You know, I don't know. I don't burn up too much energy thinking about it. I'm just observing what's happening and responding to it. Okay, while we're here, we'll just check the currencies. So there's the US dollar. We had a series of higher highs and higher lows that ran its course by the end of March, and now we're doing the opposite, and we're back down to this quite critical support level, just under 90. So an important juncture for the US dollar. If the Fed is forced to raise rates, then you'll see the US dollar strengthen, because it will attract in money from elsewhere around the world at a higher rate. But at the moment, there's no real sign of that. Interestingly, despite the fact that the US dollar fell slightly, the Australian dollar also didn't do all that well and was actually down on the week. Finished at 76.9. So that's an interesting shift. And look, it could be tied to the fact that you know, people are getting increasingly nervous about the iron ore price, whether it can be sustained. But yeah, an interesting lack of follow through there on the Australian dollar. Now let's look at the ASX 200. So again, this index is really just consolidating. It was pretty flat on the week. I think it just gained a handful of points. But if we look through the actual underlying, this is energy, which you can see in Australia is breaking down. So we're obviously the 50-day moving average has turned over. The value of the index has now dropped below the 200-day moving average, and it's only very minor, but we've also broken a support level. So energy not looking all that flash in Australia. Banks obviously had a very good couple of months. Didn't do much on the week itself. Healthcare was the big gainer, particularly on Thursday and Friday. But the drag on the Australian market was really materials, was the big drag. So BHP and Rio. So again, this could come back to future perceptions about iron ore and how that's impacted the Australian dollar. But the interesting thing for me is, I'll just whiz through here. There we go. So there's the XLE. So if we look at XEJ, that's the Australian Energy Index. So clearly heading down, 50-day turned over and heading down, the price below it. But look at the XLE in America, the energy sector there. All the moving averages are heading up and the price is above them. So an extreme divergence between the performance of energy across the two countries. So if you want to own energy stocks, you really don't want to own them in Australia. You want to own them in America if you have the choice. All right, so just to run through this, so 76.9 is where we finished on the dollar. Our index gained just 16 points, but healthcare was the star there. Speculation in resource developers is still there, but we're seeing an enormous amount of volatility. We're seeing 20-30% gains and then retracements in very short periods of time, just a couple of days. So it's a bit of a rodeo, the resource sector, but the medium to longer term outlook is obviously extremely positive. But it's one that you want to be very clear about what your game plan is if you're going to participate in it, because the volatility is pretty extreme at the moment. You need to know what you're doing. Precious metals, gold up strongly. That was really probably one of the big stories of the week. 1882 broke through a resistance level. Silver not really following to the same degree as it was. The next major hurdle for gold, as we'll see on the charts, is at 1960. And if we turn to GDX, then the price jumped out of the trend channel that it had been in, and the trend for GDX is clearly accelerating. And GDX is up 27% from its January lows. So let's take a look at the gold price. First of all, I'll just show Bitcoin. So this is what I said about 3 or 4 weeks ago, and I left it in there just as a reminder. What if, so when Bitcoin was up here somewhere, so I said, what if it retraced to this zone, which technically would be quite normal, so between the 38.2% and the 50% Fibonacci retracement levels. When it was up here, it didn't look like it was, heading in that direction, but inevitably the C leg has emerged, and it emerged very dramatically, and it declined from around 56,000 on the 12th of May, and just 10 days later we're down at 37,000. So it's been a huge drop, and intraday on Wednesday you can see we actually went all the way down to the 61.8% level. And that also picks up these lows here, the lows from January as well. So let me take this out because that has now happened. So let me take those two comments out. And let's try and get a sense of where to from here for Bitcoin. It's just too early to say. It's been such a meteoric drop. We will get some period of consolidation. It's going to be extremely volatile, and it's probably going to be in the range between this support here at 31,000 and perhaps as high as 44,000. So I would expect to see a zone of consolidation between those two levels for a period of time. What it does after that, it's just impossible to say. So I'm completely neutral from a technical perspective on what happens with Bitcoin from here, but I think you can expect extreme volatility to continue. And part of the reason that's driving this, apart from people like Elon Musk tweeting various things, is just the reality of the market. Recent buyers who bought, anywhere from here up, so anywhere from February, when the price was at sort of 40, 45,000, all the people that bought up through here, a lot of them inexperienced traders that have, probably got little idea what they're doing, haven't experienced a sudden loss of capital, don't know what that feels like, and are now, totally bewildered. What are they going to do when the price of Bitcoin rallies, even a little bit, back perhaps to where they bought? They're going to sell because, they've just been burnt very, very badly. So human psychology is going to kick in here, and logic and long-term thinking just goes out the window. So I think any rallies, when I've been in the market long enough to know how markets react, and it's not got nothing to do with Bitcoin. This is how markets react in every part, every asset class. There will be people that will come out who are now underwater, significantly underwater, they're hurting badly, and they will sell into rallies. So it's really hard to see Bitcoin rallying back to any significant extent, because that's just not how human psychology works. It's got nothing to do with the fundamentals. So you can stamp your feet all you like and think that Bitcoin is the the future of finance, and therefore it's just going to go straight back up again. I can tell you that human nature is going to get in the way of that for a period of time until until we flush out all those newcomers to the market who are who are getting hurt by what's going on. All right, let's turn into precious metals. This is gold. You can see now we're in a very strong uptrend on a weekly chart again now. Technically, this is behaving very well on a big picture level. If we put the Fibonacci structure from the lows in 2018 to the highs in August of 2020, then this pulled back to exactly the 38.2 and then has resumed a pretty strong uptrend. And if we look at this on a daily, you can see we've got a very clear uptrending channel there. We haven't really got to excess yet. We haven't got to the top of the channel or tried to break out over it. But let's see what we have got. We've taken out multiple prior peaks here, here, and 2 more here. So we've taken out 4 prior peaks. That's significant. So we're in an unquestioned uptrend. We've got higher highs and higher lows. The shorter term moving averages are now turned up. The blue line is the 50 and the green line is the 20. They're now quite sharply turned up and accelerating. The price is now above the 200-day moving average, and that has an impact in the gold market because a good part of the market trades on technical patterns, and being above the 200-day moving average is important. So all the stars are aligned for the gold price. The next challenge is up here around 1960, and I see no reason why that why that won't be achieved with the current trend. If we flip over now to GDX, GDX jumped out of the top of the channel here. Very, very powerful day on Monday, and then it's got into a little consolidation, but didn't pull back. So a lot of strength in GDX, and this trend is really starting to accelerate very nicely. So things looking good for gold. Turning to other commodities, copper fell to 451, nickel fell to 770, which is really interesting when the US dollar went down slightly. And I read it that we've just got short-term enthusiasm in the market, pushed the price of copper and nickel and other commodities up a bit too quickly, and so we got a bit of a flushing out of that frothiness. Crude oil 63.88, so down a couple of dollars, and I've shown you that very, very stark divergence between the Australian energy market and the US energy market. So there's the spot copper chart. We got a bit of a retrace, and the same thing happening with nickel, but the long-term outlooks are still very robust. So my final thoughts: at some point there will be a rotation back to growth. So this is not a set of circumstances that's going to remain with us for a lengthy period of time. But I think what will happen is the rotation back to growth will be growth companies that have got real earnings. I think the phase we went through where there was an enormous amount of speculative growth, if you look at the renewable energy stocks is probably one classic example, forgetting Bitcoin and a few others, but renewable energy stocks, absolutely took off and went up many, many hundreds of percent with, and they're great long-term stories, but it's just they've got no earnings for a period of time. So I think the rotation back to growth will go back into larger cap stocks with real earnings. So I wouldn't sort of be salivating about the speculative growth stocks coming back again where you can make a couple of 100% in a few months. I think that phase won't return for quite some time. Now, the rotation back to growth, there's no signal of it yet, so just cool your heels on that one. It's most likely to occur when everybody starts looking the other way. When the trend in all the things that are trending up strongly now, when that becomes so entrenched that people can't see anything else, and they think that that's just going to continue, that is when the rotation back to growth stocks is most likely. And I'm not really seeing that at the moment in the charts. But more than ever, being a contrarian when sentiment gets extremely positive or extremely negative has never been more important. It's just markets are so volatile now and are being pushed to extremes so much by algorithms that you need to be on alert. You don't want to try and anticipate the changes, because they can run further than you think, further and faster than you think. But when everybody starts to think the same way, you really need to be alert and be looking for the signs of changes. And certainly one of the good ways to do that is those relative strength comparisons between the sectors and within the sectors, which is something that I do pretty much every day. So, that's what you need to be alert for. Don't form strong opinions on what you think should happen, because it's just a complete waste of time, and in fact it'll do you more harm than good. Just follow what is. Portfolio analyst last week covered what to expect in coming months and from a probabilities perspective, and also did a little bit of a reality check on hedging from some members that were interested in steps that they can take to protect themselves in corrections. So I think that was quite an interesting session as well. All right, that's it for this week. There's my contact details for more information, and we'll be back with you next Sunday. Cheers.